Hello and welcome to the Financial Tea here at the Calvert County FCS Extension. My name is Charles, your AI video puppet. Our story today is about helping beginners understand the stock market. We are going to be talking about trading, the risk with purchasing stocks, index funds, and tips to guide you as a beginner. We will be going live shortly with our very own Dr. Troy Anthony Anderson.
Everyone, it's Dr. Troy from the University of Maryland, Calvert County Extension. So today I just want to talk to you a little bit about the stock market. Now, the stock market is where investors buy and sell shares for companies. And one of the things that is most important in doing a stock market investment or an exchange is to understand that the stock market is really a set of exchange where companies issue shares and other securities for trading. It also includes what is considered the OTC, over-the-counter marketplaces, where investors have an opportunity to trade securities directly with each other.
Can you share any tips for beginners?
Avoid individual stocks. If you're a beginner, you create a diversified portfolio. Stay committed to the long-term portfolio as well and avoid short-term trading. You don't want to be doing any short-term trading.
Are there any advantages to acquiring an index fund?
Key advantages of an index fund is that you immediately have ranges of stocks in the fund. For example, if you own a broadly diversified fund, and as I talk about diversified fund here, you want to make sure that, if I haven't said it, you're diversifying your portfolio, because you'll own stocks in hundreds of companies across many different industries, and this is what is going to increase your chances. But you could also buy a narrowly diversified fund which is focused on one or two industries, right? But nonetheless, diversification is very important, because that when you diversify your portfolio, it reduces the risk of any one stock within the portfolio hurting the overall performances as you go through.
To expand on the benefits of buying multiple stocks compared to purchasing an individual stock.
In contrast, if you're buying only one individual stock, you really do have all your eggs in one basket, as my grandmother would say. So the easiest way to create a broader portfolio is pretty much buying into an ETF. Or buying into a mutual fund. Now, I usually tell people when they get their first paycheck, hey, go open a money market account and start saving. Start seeing how that little profit margin go for you.
Is there a way to minimize the risk of losing money as a first-time stock investor?
People all the time, I say, you know what, try a stock market simulator before you invest your real money. Or try one of those that, you can lose 50 cents here or there. That works for you, or $1 or $10. But don't take up your lump sum of money. And when I say lump sum, I mean you sold your house and you got the equity from that, and you're like, oh, that's a $30,000 equity. Let me go ahead and invest this into stocks. No, do not do that. Right? Now, one way to enter the world of investing without taking risk is to use a stock simulator. Now, you can use this online through trading accounts with virtual dollars because this won't put your real money at risk. So be sure to check that out before you decide, hey, I am going to go ahead and invest this lump sum of money, because you'll also be able to determine how you would react if this really were your money that you gained, or even in a situation where you lost this money.
Should I take advantage of short-term trading? Is short-term trading riskier than long-term trading?
It is important to understand and avoid short-term trading. Now, understanding whether or not you're investing for a long-term future goal or a short-term goal is really important to determine your own strategy, because whether you should be investing long-term or short-term, it really boils down to what you already have and what your future goal is. Now, sometimes short-term investors can have unrealistic expectations about how money grows and how interest adds up. It's like, I don't know if you've ever had a bank account before, right? It's your first bank account, and every minute, every day, you check, I wonder how much interest I have yet. Alright, they put 20 cents, I wonder what will happen tomorrow. Right? And so that level of expectancy and anticipation builds up. But it doesn't necessarily work that way with stocks. And so research over the years has shown that most short-term investors, and when I say short-term investors, I'm talking here about like day traders. They tend to lose money in great amounts because they're thinking, hey, I'm going to get up early in the morning, I'm going to hit it the ground running. But at the end of the day, the stock went down, right? And they pulled up.
Is it common for the stock market prices to fluctuate?
So while stock prices in the market on any day fluctuates according to supply and demand, or the shares that are demanded or supplied, so to speak, over time you will recognize that even with the biggest of stock markets, they have to evaluate companies based on business results and future prospects. So a business growing sales and profits is likely to see a rise in their stock, while a shrinking business, on the other hand, probably see a decrease in their stocks. At least over time, they will see a decrease. So in short term, this is why I said that in short term here, the performance of a stock has a lot to do with just the supply and demand within the market. So when private entities see a particular stock that's in favor, they may decide to fund their business by selling stock and raising cash. However, in doing so, a lot of us get caught up, especially as investors sell their stock later in the stock market. They want to do, or they can buy even more at any time the stock publicly trades.
How do investors price stocks? And do you have any tips from Extension?
Investors price stocks according to their expectations of how the company business will perform in the future. So the market is forward looking, therefore market anticipates events about 6 to 9 months away, and so they're able to kind of predict, right, from here on out in terms of that initial public offering. But there are risks and benefits of investing in stocks, and I want you to understand those as well. So make sure that you talk to a stock market broker, allow for them to go through the pros and the cons with you, or visit your local university extension and get some assistance or some guidance on making the right investment, because this too can include a nice cash dividend, I'm telling you. So investing in stocks also offers a nice tax advantage for long-term investors. So it's something to look into, but you want to start early. You don't want to wait until it's time for retirement, then you're thinking about stocks and then probably go take up all your retirement money and put into stocks. No, don't do that, right? So start early, start planning, and make sure that you stick to the stock for a long-term process, because you're not going to see a turnover by the end of the day. I mean, you may be lucky,